All right, let's talk about a word that we all use, probably every single day if you're in the markets: risk. We all think we know what it means. But what if I told you the common definition isn't just a little off, but that it's dangerously wrong? Let's get into it.
So think about it for a second. What really is the biggest risk in trading? Is it losing money? A sudden market crash? Is it just being flat out wrong about a stock? Most people would say one of those things, but we're about to challenge all of that.
And here it is. This is the one idea that changes the entire game. Risk is not loss. Loss is an outcome. This is how professionals think. See, it separates the decision-making process from the result. And that simple, powerful distinction is the key to long-term survival in this business.
Okay, so let's build this new way of thinking from the ground up. We're going to dismantle how most people look at risk and swap it out for a framework that's built for durability, not for just trying to predict the future.
This right here shows the huge divide between how amateurs and pros think. Amateurs define risk ex post. That means after the trade is over. They have a losing trade and they go, wow, that was really risky. But professionals, they define risk ex ante before they ever click the button. They're thinking in probabilities about all the things that could happen. A good, well-thought-out trade can still lose money. A terrible trade can get lucky and win. The outcome doesn't define the quality of the risk you took.
And this just nails it, doesn't it? The market couldn't care less about how brilliant your thesis was if a string of bad luck knocks you out of the game. It's not about being right on one single trade. It's about setting things up so you can keep playing, day after day, surviving that inevitable uncertainty long enough for your edge to actually show up.
Now, to really get this, we've got to be super clear about the words we're using. People throw around terms like uncertainty, volatility, and risk like they're all the same thing. They are not. They're fundamentally different. So let's break them down real quick.
First up, we've got uncertainty. This is the big one. It's the simple, fundamental fact that we do not know what the future holds. It's like a fog that covers everything. You can't get rid of it. You can only learn how to navigate through it.
Then there's volatility. Now, this isn't the danger. It's just the measure of how much prices are bouncing around. Think of it as the bumpiness of the ride on the ocean. In fact, for traders, volatility is just a cost of doing business. It's necessary. Without it, there'd be no opportunity for profit.
And that brings us to the most important definition of all: risk itself. Risk isn't just any random loss. It is the exposure to outcomes that cause real structural damage. Outcomes that permanently impair your capital, that tie your hands and stop you from acting in the future. Or, and this is the big one, that threaten your very ability to keep participating at all.
So here's a great way to think about it. Uncertainty is the fog you're sailing through. You just can't see what's ahead. Volatility, that's the size of the waves rocking your boat back and forth. You expect waves. But true risk, that is the chance of hitting an iceberg that sinks the entire ship. See? You can handle the fog, you can handle the waves, but you have to avoid that ship-sinking event at all costs.
So if risk is the chance of the ship sinking, what's the iceberg? Well, in trading, the most common and dangerous iceberg has a name: drawdown. This is the real monster under the bed that we need to manage.
Now, volatility and drawdown can feel the same in the moment, but they behave in totally different ways. Volatility oscillates. It goes up, it goes down. But a drawdown just accumulates. It's a one-way street of compounding losses from your account's high point. It's what we call asymmetric, and the path it takes is what causes the real, lasting damage.
And I'm telling you, the math of drawdown is absolutely brutal. Just look at these numbers. If you lose 10%, you need an 11% gain to get back to even. Okay, not so bad. But if you lose 25%, now you need a 33% gain. It's getting tough. And then, the big one. A 50% loss requires a 100% gain. You have to literally double your remaining money just to get back to where you started. The hole gets exponentially harder to climb out of.
And that is exactly why the path you take matters so much more than your destination. I mean, who cares if your strategy could have eventually made a fortune? If the path to get there involves a drawdown so deep that you're forced to quit or you get a margin call, you're never going to get there. You won't be around to see the end point.
Okay, so now that we have a feel for this, let's get really specific. Let's look at the core properties of this true risk we're talking about. It's not some vague feeling. It has specific, identifiable traits.
So first, like we just saw, risk is path-dependent. The sequence of your wins and losses matters. A string of 5 small losses can be way more damaging than one big one. And second, it's asymmetric. A 30% loss does so much more than just reduce your capital by 30%, it cripples your ability to take future opportunities. It hurts you way more than a 30% gain actually helps you.
Risk is also state-dependent. The exact same position in your portfolio might be perfectly safe in a calm market, but absolutely lethal in a volatile one. Risk isn't static, it changes. And finally, risk exists across multiple horizons. What's risky in the next hour is totally different from what's risky over the next year, and you have to think about all of those timeframes.
So, what's the ultimate point of all this? If risk is really about avoiding that irreversible, ship-sinking damage, then the number one goal of any trading plan can't just be make money. It has to be something much more fundamental.
And here it is, the ultimate definition. Risk is the set of conditions under which participation must cease. That's it. That's the boundary line. Anything, literally anything, that could force you to stop trading, running out of money, breaking a risk rule, losing your nerve, that is the risk you have to manage above everything else.
I love this final quote. It's so powerful. All those complex tools we have, VAR, standard deviation, all of it, they aren't there to help us squeeze every last dollar of profit out of the market. No, they are simply tools for one thing, and one thing only, keeping us inside the survival envelope, making sure we live to trade another day.
So I'll leave you with this question. When you really look at your own trading, your own approach, are you managing for short-term profit? Or are you truly, honestly managing for long-term survival? Because the answer to that question might just change everything for you.